Welcome back. I'm Judith Peckett, Accounting 201, and our topic is the annual report and IFRS, pronounced IFRS. For this class and for Accounting 202, we will study corporations, and you will do a project in which you go out and find the annual report of a publicly held, publicly traded corporation whose annual report is on the Securities and Exchange Commission website. Corporations are required to prepare an annual report, which include the 4 financial statements we discussed above, as well as management discussion and analysis, notes to the financial statements, and the auditor's report. Let's take a look at Chipotle table of contents for their annual report. The section we're going to focus on is the management discussion and analysis. The MD&A, Management Discussion and Analysis, shows management's view on the company's ability to pay its near-term obligations. In other words, can they pay debt that is due within the next 30 days to a year? Number 2, management's view on its ability to fund operations and expansion. So remember, funding is about your finance source, whether that be debt or whether that be equity stock. And we're trying to fund our daily operations as well as any growth, opening new stores, opening new factories. And then finally, it's results of operations, net income, net loss, sales trends, and so forth. Management must highlight the good news and the bad news and the trends, and it is required to identify any significant events or uncertainties that affect these 3 areas. An example of an uncertainty could be a lawsuit, where if they lose, they might have to pay millions of dollars. Here is a brief section from the management discussion and analysis. They go on for pages, but Chipotle starts with their operating results, what's happening on the income statement, and they talk about the fact that the company has grown. Comparable restaurant sales increased 4% for the full year of 2018. Sales trends were 2,004 million in 2018, 1,940 million the year before. So that's an example of how they're focusing on operations. We're not going to go through all of the annual report right now, just give you some highlights. The other section of the annual report are the notes, and the notes go on for pages and pages and pages, and that has increased since the passage of the Sarbanes-Oxley Act, as companies wanted to be sure they were in compliance and providing proper details to the stockholders. So what they do in the notes is just give you more detail on what kind of accounting methods the company uses, as well as helping the reader better understand the business. So here we have Chipotle talking about how they recognize revenue, but want to be sure that the reader understands they don't include the sales tax they collect as revenue. Finally, we have the auditor's report. Auditors, every publicly traded company must have an independent outside CPA firm review the financial statements. A CPA firm is a firm with certified professional accountants, and that's a national certification. They review the financial statements and they provide a statement about whether the data is a fair representation of facts. Again, auditors don't check 100% of statements, they do a sample, and whether it is a fair representation of facts as well as whether it is in accordance with GAAP. Remember what GAAP is: generally accepted accounting principles. This is key. Companies must pass their audits with the auditors, or else the annual report, this auditor's report, comes out and says you did not pass this for these reasons. and companies have a choice of fixing those problems or probably having a loss in their stock value among the least of their worries. Chipotle's auditors were the company Ernst & Young, and again, only CPAs can conduct audit. Before we end this topic, I want to mention the International Accounting Standards, International Financial Reporting Standards. This is used in about 120 countries, but not in the United States. In the United States, we use Generally Accepted Accounting Principles, or GAAP. What are some of the differences? GAAP is rules-based. There are many, many rules, accounting rules that companies have to follow. IFRS, International Financial Reporting Standards, is principles-based, and it's simpler. Principles-based means that the reader is given a guideline, the user is given a guideline, and they are expected to interpret the guideline in practice. Rules-based means here is the exact rule for this situation and you must follow it. And if there is not a rule, you can interpret it differently. And that is what happens. And so what happens in GAAP is that more and more and more rules have to be written for every single situation. GAAP also requires adherence to the Sarbanes-Oxley Act. IFRS principles are created by the International Accounting Standards Board, and that consists of people from many different countries. GAAP rules are developed by the Financial Accounting Standards Board, and that is United States based. You are not responsible to understand IFRS in this class as we teach GAAP. However, there's a strong belief that the two systems will merge in the future. Here's a recent list of countries who use IFRS. This concludes the video.